March 2020. Markets are in freefall. Sarah, a small-time investor, watches her portfolio lose 30% in days. Her instinct screams to sell everything, but she pauses. She pulls out her checklist, takes a deep breath, and follows the steps. By the time the market rebounds, Sarah has not only avoided losses but doubled her gains. This system works because it keeps you grounded when emotions run high. Behavioral finance explains why this is so critical. Your brain isn't wired for rational investing during crises. Fear and greed take over, pushing you to sell low and buy high. Herd mentality makes you follow the crowd straight off a cliff. Loss aversion tricks you into holding losers too long and selling winners too early. These aren't character flaws, they're human nature. But nature can be beaten with preparation. Here's your emotional checklist for the next market crash. Print it, save it, stick it on your wall. These steps will keep you focused when blood is in the streets and your instincts scream to run. Rule 1. Pause before clicking. When markets drop 5% in a day, your first urge will be to act. Don't. Set a 24-hour rule. No selling decisions until you've slept on it. During the 2020 crash, investors who waited just one day often avoided panic selling at the lows. Markets move in cycles, not straight lines. Measure twice. Cut once applies to selling two. Before dumping any position, answer these 3 questions. Has the company's long-term outlook changed? Are operating cash flows still positive? Is the balance sheet strong enough to survive? If the answers are no, no, and yes, hold tight. Price drops without fundamental deterioration are opportunities, not threats. Implement the 1% rule for risk management. Never risk more than 1% of your total portfolio on any single trade. This automatic circuit breaker prevents any one decision from ruining you. If you have a $100,000 portfolio, that means limiting losses to $1,000 per position. Knowing you're protected takes the edge off extreme volatility. Rebalance on schedule, not emotion. Set predefined dates to adjust your portfolio. Quarterly works well. Stick to them regardless of market conditions. This forces you to sell high and buy low systematically. Emotional traders do the opposite. They chase performance and flee declines. Your calendar is your co-pilot through turbulence. Keep a trading journal. Write down every decision and why you made it. Note your emotional state at the time. During the 2008 crisis, traders who journaled avoided repeating mistakes because they could review their thought process. Patterns emerge. Maybe you always sell too early when worried about work stress. Spotting these tells helps you separate logic from emotion next time. Set price alerts, not market watches. Obsessively checking tickers feeds anxiety. Instead, program alerts at key levels you've predetermined. If Apple hits your buy target, you'll know. Otherwise, turn off the noise. In March 2020, investors who stopped watching CNBC made better decisions than those glued to the fear-mongering. Finally, remember your worst trade. We all have that one terrible decision that haunts us. Maybe you sold Amazon in 2001 or bought Bitcoin at the 2017 top. Keep a reminder of it visible. When the next crisis hits, ask, am I about to repeat that mistake? Sometimes fear of repeating history is the best teacher. My personal crash playbook, step by step. When the next market crash hits, here's exactly what I'll do. No secrets held back. This playbook comes from studying every major crash from 1929 to 2020. Most investors fail because they lack a written plan, making emotional decisions that cost them money. You can use this as your template or adapt it to your own strategy. First, I'll check the Buffett Indicator. If total market cap to GDP drops below 80%, it signals bargain territory. During the 2008 crisis, it hit 75%. Below 70% means it's time to act decisively. This metric has reliably predicted major market bottoms since 1950. Next, I deploy cash strategically. I always keep 10% of my portfolio in cash equivalents like treasury bills. This becomes my ammunition during crashes. I divide it into 3 portions. The first third gets invested when the Buffett Indicator hits my target, the second third after a further 10% drop, and the final third if another 10% decline occurs. Think of it as stepping down a staircase, ensuring I don't go all in too early. For stock selection, I apply 5 filters. First, balance sheet strength, current ratio above 1 and manageable debt. Second, cash flow stability, positive operating cash flow through cycles. Third, industry resilience, favoring consumer staples and healthcare. Fourth, valuation, PE and PB below historical averages. Fifth, competitive advantage, brands or patents that endure. These criteria ensure I'm buying quality companies at attractive prices. I focus on dividend payers with sustainable yields. During the 2008 crisis, companies maintaining dividends recovered faster. I target yields between 3-6%, high enough to reward patience, but not so high that cuts are likely. Dividends act as a margin of safety while markets recover. Position sizing is critical. No single stock exceeds 5% of my portfolio. I size positions based on volatility. Stocks with larger price swings get smaller allocations. For example, in a $100,000 portfolio, a stock with 5% daily moves might get 2%, while one with 2% moves could get 5%. This keeps risk balanced. I set price alerts instead of watching markets constantly. Obsessing over tickers leads to bad decisions. Alerts notify me when key levels are hit, so I can act deliberately. In March 2020, investors who avoided constant monitoring made better choices than those glued to CNBC. Tax loss harvesting happens automatically. Any position down 20% or more gets reviewed. If fundamentals remain strong, I'll sell to capture the loss and immediately buy a similar replacement. This locks in tax benefits while maintaining market exposure. Rebalancing occurs quarterly, regardless of market conditions. If stocks drop below target allocation, I'll use cash to buy more. If they surge above target, I'll trim winners. This forces me to sell high and buy low systematically. I monitor the worst performing sectors closely. In 2008, financials were crushed, but the strongest banks rebounded dramatically. I look for sectors down 40% or more, then identify the healthiest companies within them. Options play a supporting role. I buy puts on stocks I own as insurance and sell cash secured puts on stocks I want to own at lower prices. This generates income while setting buy points below market. Finally, I journal every decision during market stress. Each trade is recorded with my reasoning and emotional state. This creates accountability and helps me identify patterns, like selling too early when stressed. Crashes are normal. The key is having a plan so you can act when others panic. When to sell, locking in crash profits. Knowing when to sell is just as important as knowing when to buy during a market crash. Even the best crash purchases can turn into losers if you hold them too long. Many investors make the mistake of getting greedy during recoveries, watching their paper profits disappear because they didn't have an exit strategy. Here's how to lock in your gains without leaving money on the table. To simplify, here are the key sell signals to watch for. Valuations returning to historical norms. That stock you bought at a PE ratio of 8 during the crash? When it hits its 10-year average PE, it's time to reevaluate. In 2009, investors who bought bank stocks at fire sale prices saw many triple within 2 years. The smart ones sold when valuations normalized, while others held too long and gave back gains. Check metrics like PE, PB, and dividend yield against their long-term averages. When they reach typical levels, consider taking profits. Market sentiment and technical indicators. When headlines shift from doom and gloom to irrational exuberance, pay attention. In early 2020, fear dominated in March, but by August, everyone seemed to be a stock market genius. This shift from fear to greed often signals the end of easy money. Tools like the CNN Fear and Greed Index can help. Combine this with technical analysis. If a stock that's been rallying falls below its 200-day moving average on heavy volume, it may indicate a trend reversal. These signals together can help you time your exits more effectively. Position sizing. If a crash purchase grows to more than 10% of your portfolio, trim it back. For example, if you bought $5,000 of a stock during the crash, and it grows to $15,000 while the rest of your portfolio stays flat, selling $5,000 brings your position back to a manageable size while locking in gains. This method takes the emotion out of selling. Dividend cuts. Companies that can't maintain payouts during recoveries often have deeper problems. During the 2008 financial crisis, banks that cut dividends typically underperformed for years. If a company you own cuts its dividend, it's a clear signal to move on. Insider selling. Watch for spikes in insider selling. If multiple executives at a company you own are dumping shares during the recovery, it's worth investigating further. While not always a reason to panic sell, it can be a red flag. Sector rotation. The sectors that lead during recoveries often lag afterward. Financials led after 2008 but underperformed later, while tech led in 2020 before giving back some gains. When leadership shifts from your crash purchases to other sectors, consider reallocating. Tax considerations. If you're sitting on big gains, think about holding at least a year for long-term capital gains rates. But don't let taxes dictate your decisions. If your thesis has changed or fundamentals have deteriorated, it's better to pay the taxes than watch gains disappear. Original investment thesis. Always return to your original thesis. If the reasons you bought the stock no longer hold, it's time to sell. Stocks don't care what you paid for them. They only care about future prospects. One investor in 2009 used a laddered sell strategy to avoid greed. They sold 1/3 of their position when valuations hit historical averages, another third when they reached 1 standard deviation above, and the final third at 2 standard deviations. This approach locked in gains while leaving room for further upside, a disciplined strategy that paid off. Finally, don't forget to rebalance regularly. If your crash purchases have grown to dominate your portfolio, rebalancing forces you to sell high and buy low. Set calendar reminders to rebalance quarterly or annually. This systematic approach removes emotion from selling decisions and keeps your portfolio balanced. Market crashes don't destroy wealth. They transfer it to those who are ready. When stocks plunge, most see disaster. You'll see opportunity. Crashes are when fortunes are made. The next time markets tumble, you won't freeze, you'll act. With tools like the Buffett Indicator, sector rotation strategies, and a calm mindset, you'll be prepared. Start today. Build your cash reserve, study valuation metrics, and practice staying steady under pressure.